Hello everyone and welcome to your Glassnode video report for week 17, 2022. So we're going to shift our focus this week and really spend a bit of time understanding the derivatives market. And there's a lot of information that we can pull out of this because really from 2017, derivatives really represented a very small part of the overall trade volume. They were a fraction of the overall spot trading. Now what we see in 2022 is that, and even through 2021, futures and options and all these derivatives have actually become the dominant source of trade volume. So it's gone from being a fraction of spot to being many multiples of spot volume. So we've seen a lot more attention move towards this market. They are a little bit complex, particularly for those who don't have a financial background. So we're really going to explore some of the mechanisms of what's actually going on under the surface within this, and a particular focus in this instance on perpetual swap market. So we'll really explore this in some detail. So what we've seen over the last, well, really 2022, but essentially since January last year, we've seen this gradual and very, very structural decline in trade volume, in overall volatility, in the yield that's available from cash and carry style trades. We've seen this kind of squeezing out of all of the juice, so to speak, from the Bitcoin market over the last 12 and a bit months. So during this whole process, we've also seen that perpetual swaps have become the preferred vehicle. So we see that most of the trading volume is actually moving towards perpetual swaps and not the calendar futures. And we will explore this in more detail as we go. So if you haven't heard some of these terms before, sit tight and we'll explore them one by one. Now, what we're also going to look at just to close out is a bit about the on-chain transaction volume, just understanding a bit about what's going on, how market structure has similarly changed since really October 2020. And we're going to then compare that to an NVT valuation model that Willy Woo came up with a number of years ago to try and translate the on-chain transaction activity and the utilization of Bitcoin as a settlement layer back into a pricing model. So we're going to look at this from a couple of different angles, but really focus on transaction volume, the amount of utility, and then also a strong focus on the derivative space. So as always, please do give us a share and a subscribe and a like. It does help this channel get more views, and I do appreciate you watching these. Hopefully you find this one useful. We're diving into derivatives and just understand a little bit more about this, kind of different market. It is different to the on-chain space, but we do need to keep capture of both of these because they both play a very, very important role. Both the spot on-chain and the derivatives, there's a lot of interplay, and just understanding how that works will give you advantage in understanding what this market is doing. So as usual, we're going to start with our initial dashboard. I won't spend too much time looking at price action because as per last week, we continue to trade within this bear flag. We really don't have a great deal of momentum as yet. We seem to be just kind of sitting within this price range, and our accumulation is much the same. We're kind of seeing this off, on, hot, cold. It's a little bit of everything. We haven't quite seen momentum either to the upside or the downside just yet. Now, when we move across to our derivative space, so this is a couple of trends that I really want to focus on. So at the top here, I have our futures open interest. Now, this includes both perpetual swaps and calendar futures. So just to give you a very high level, a calendar future is something that actually has an expiration date. The contract will expire on October 30th, 2022. And between now and then, the price will close in. So whatever the futures market is pricing it in, it may be at a premium. It typically is at a premium. As time goes on, the spot price will close into that futures price and close down that premium. Now, the reason that these calendar futures exist is typically it's actually borrowed from the traditional commodities markets because there's a storage cost, there's an overall transportation and delivery cost of things like oil or gold. And as a result, pricing things in the future, you may not want all of your oil right now. You may actually want to purchase some in the future. And likewise, oil producers want to sell some in the future. So there's a market for actually pricing in what is the future production and delivery costs. Now, Bitcoin really doesn't have the same momentum here. It doesn't have the same costs in terms of storage because it's a digital asset. In terms of delivery, all of these costs essentially collapse down to zero. So as a result, the market really innovated, and actually it was BitMEX that came up with this structure called the perpetual swap. Now, this is a futures contract that does not expire, and it keeps things in tandem, the index price in line with the actual spot price, by using something called the funding rate. So there's two different types of futures markets, and we're going to explore all of these in detail. Now, these first two models, the open interest is the amount of open contracts. These are 50% longs, 50% shorts. So for every single one that's open, there's somebody else on the other side of that trade. So it doesn't give us a directional bias. But what we can see is that we're kind of just hovering around this, relatively low value. It's a little bit above where we were in May, June, July. It's nowhere near as high as we were up at the peaks. It's about 40% less open interest. So we do see that there is less volume and less overall contracts open as we've seen at the bull market peaks. But as you can also see, there is a correlation between the overall open interest and price. It generally speaks that when you have a trending price higher, more people want to speculate. When you have more bearish price action, that generally slows down. So at the moment, we're not seeing a huge amount of open interest on a relative basis. Now, the second one is looking at futures volume. These are all the contracts that are being traded. And what we can see is that there was a strong push. There was a lot of trade volume all the way through to around June. And as you can see, there's kind of this long-term big picture triangle. It's descending. And where we currently are, we're down about 60% in terms of overall transaction volume or trade volume since what we saw back in the bull market peak. So you can really see that in many of these, and you'll actually see this through a number of these charts we're about to look at, this kind of downward sloping triangle, this gradual compression and reduction of overall leverage in the system is a trend that we've seen across a number of these derivative markets. So we're going to explore the mechanisms as to why that is. So just before we get started on that, what I want to highlight here, this is our perpetual futures dominance. Now, what we're looking at here is in the pink curve, we have our open interest dominance. So this is looking at of all the open interest in the futures market, how much of it is perpetual swaps. So that's the open interest. And we also have the trade volume here in this blue color. Now, what I want to highlight is that at the moment, in fact, let's go back a little bit. If we go back to our all-time high back here in December 2020, this is the last cycle all-time high. So let's use this as our reference point. We had around 50% of the open interest with perpetual. So it's 50% perpetual, 50% calendar futures. And we had about 77% perpetual versus calendar futures in terms of trade volume. Now, what you can see is that both of these curves have been trending up and to the right. So what this is actually showing, where we are at the moment, perpetual swaps account for 92.4% of the trade volume. It's up from 75 to 92%. So this is showing that people just simply prefer to trade perpetual swaps. And we're also seeing that the open interest dominance rose from 50% to 66%. So what this is really showing is that the market has over time found a preference. It prefers to trade these perpetual swap markets. And in our open interest up here, it's about a 2-to-1 split. Of the $15 billion that we have in total open interest, 10 billion of them are now perpetual swaps, which again is showing that 66% that we have here. So really to understand what's going on, in terms of our open interest leverage ratio, what we're seeing here, this is only perpetual swap markets. Now, this is taking it as a ratio of the market cap. So again, I'll bring it back to that engineering analogy. We have the Bitcoin market size. That's the thing that the market is trying to move. It's the object to be moved. And the more leverage we have in the system, the more likely that is to be moved. That's the open interest or the perpetual open interest. And much the same as this dominance chart, you can see that our leverage ratio, the amount of open interest in the perpetual market relative to the market cap, has continued to climb over time. And you can see we're actually up here at what it would otherwise be classified as a very high level. About 1.3% of the overall Bitcoin market cap, that is the size of the perpetual open interest. Now, you may have seen in previous videos when we see this very high leverage ratio, that would be a signal that, oh no, we actually have to have some kind of leverage flush out. Now, of course, that can always happen. This is not a small amount of leverage. We do have a large amount in the system. But what I also want to bring it back to is say, well, we've also seen this growing dominance of the perpetual swap market. So what we've actually seen is that a great deal of the calendar futures, the trade volume, the open interest, a lot of the people who've been trading those calendar futures have actually moved their money into either the perpetual swap market or they've left the market entirely. Because when we look at this leverage ratio for all futures, not just perpetual swaps, it's actually declined over the last 2 weeks from about 2%, which is a high risk zone, down to about 1.9%. We've actually seen that leverage has left the system overall. It has grown in terms of the perpetual swap dominance. So there's more in the perpetual swaps relative to calendar futures, but more has flowed out of calendar futures than has gone into perpetual swaps. So the way to think about this, we are actually seeing capital leaving from these markets. So that's where we're now going to explore why that actually may be. Why would capital be leaving from the futures markets overall? Clearly, we've established that there's a preference for the perpetual swap market. So the first question that we ask ourselves is there a better yield to be obtained from those perpetual markets? Because if those perpetual swaps are giving a better yield for traders, then that's going to be a preferred mechanism. We're going to see capital flow out of calendar futures and into perpetual markets. So to answer that first question, we bring in the futures funding rate. This is the mechanism. It's like the interest rate that is used to keep the perpetual swap price in line with the spot prices. So what we see is that during bullish periods, we get these large green spikes. This is maximum bullishness. The way to think about this is that traders are willing to pay a very, very high interest rate every 8 hours for the privilege of taking on leverage and going long. Conversely, at the bottom of these bearish periods, we see these very, very large negative funding rates. This means that traders are willing to pay a very high interest rate to be short. And generally speaking, when we get these large spikes, you can see at the all-time high in October and November, we had this spike in positive funding rate. People were willing to pay a high interest rate, and that incentivizes people to take the other side of the trade, creating that oversupply, and eventually the market can't push through it. Now, what we said before, if we were expecting that traders are going to be moving from calendar into perpetual swaps because there's a higher yield, we would expect to see some kind of very large positive or negative print on the funding rate. But can you see that through most of 2022, it's really been very, very small. There's very little directionality in all of this. It's actually showing that we don't have that mechanism. So we're starting to build up a bit of a picture, but we certainly do not have the same kind of premium in terms of the long side, premium on the negative side. There's really so little going on. Let's zoom in just a little bit so we can see how small this is. Note how it's really just oscillating up and down, but very, very small values. Really, there isn't much incentive for people to be coming in and trying to capture some kind of yield. We're not actually seeing that. Now, let's take that same concept. So this funding rate that you see here, you'll see it's 0.005%, it's quite small. This is the interest rate paid on an 8-hourly basis. Now, let's imagine how many 8 hours there are in a year. Let's annualize that and say, well, if you took a long position or a short position and you were a market maker in these markets, how much yield could you get out of the system? Now, that's what this pink line is showing. It's showing on an annual basis what is the type of yield that you would get if that funding rate persisted. And you can see here through the bull, we're at 50%, 60%, even up above 100% yield just by holding those positions. Now, what you can also see is that it is very volatile. The yield return from this is always changing, and it also sometimes goes negative, where you're seeing that people actually are losing money if they're on the wrong side of that trade. If they're on the long side, then their yield is actually going to be negative. So it's a lot more volatile. It's a lot harder to trade in that regard. Now, the difference is that with a calendar future, which you see here in blue, it's much more stable. And depending on when the trader puts on that trade, they can actually reliably obtain that yield. Now, I mentioned before that we've probably seen capital actually leaving the Bitcoin market. And this is where I want to highlight why exactly that may be. So as you can see, same as our funding rate, how it's got very, very quiet. It's just kind of oscillating around zero. There's not much momentum. So too have we seen that with our 3-month rolling basis. And you can see that both of these mechanisms, whether it's calendar futures or perpetual swaps, are very, very low. They're very muted. The volatility's been squeezed out of the market. We don't have a great deal of speculation. The yields are actually very, very low. And at the current moment, they're less than 3%, or the 3-month basis is just above 3%. Funding rates are down at 1.6%. So now let's think about that. We've got, let's just say 3% and less in terms of yield that can be obtained from the Bitcoin market. While the 10-year Treasury yield is currently at 2.9%, and inflation is currently running at about 8.5% in terms of headline in the US. So when we look at that, essentially, if you're putting on a cash and carry trade, which is getting that 3% yield or less from the Bitcoin space, you're getting killed by inflation. And in many ways, there's a lower risk alternative in the US 10-year Treasury bill. So it makes sense that funds would actually flow out looking for better opportunities. What we're essentially seeing is the reason capital is flowing out, the reason that our overall transaction volume is declining, the reason that we're seeing that there is just generally less attention in this space is because the yield opportunity is just simply not attractive enough to bring in capital. Back here, when we're talking about 30%, 40%, 100% yield, of course, you're going to see capital flow into the market because they're going to arbitrage down that value. If there's $100 there that's relatively risk-free with these cash and carry trades, someone's going to come in and pick it up. Whereas if you have 3% alongside 8.5% inflation, it's a very unattractive trade, especially when you compare it to the 10-year Treasury bond, which continues to rally higher and in many regards are going to be viewed by the traditional finance world as a far safer asset, at least for now. So that really describes this market dynamic of why we're seeing funds flowing out of the Bitcoin space, why our leverage ratio is coming down, even though our perpetual leverage ratio is higher. So it's interesting. We're watching a dynamic where the market prefers perpetual swaps, but at the same time, overall, capital appears to be leaving. And to now come at this from the options space. So this is kind of the second set of derivatives. For those who aren't familiar, the way to think about options is a form of insurance. If somebody's buying a call option, they're buying insurance to the upside in case price rallies. They may be trying to sell down some exposure, but they want to keep that hedge, that risk, just in case the market rallies. And conversely, some people will buy a put option. A put option is downside insurance. So they're buying insurance just in case their overall position, they don't want to sell it, they want to hang on to their coins, but they also want to be protected below a certain level. So they will go ahead and buy a put option. Now, what we have here is the implied volatility. Now, you may always hear that people say, Bitcoin is a volatile asset and it's too volatile to be money and all this type of talk. What we see is periods of very high volatility, of course, talking about above 80%, 100%. That means that over the course of a year, the market's expecting more than 100% change in overall price. So volatility is a representation of literally how much the price is expected to move based on all these insurance contracts being traded. Now, during the May sell-off, we saw this spiked very high. Generally, during very high volatility moves, large market maneuvers, the market's forward pricing expands because they're expecting that volatility moving forward. Now, what we've seen over the course of 2021 and all the way to 2022 is this gradual compression, this declining amount of volatility. We got down below 60%, which is the lowest we've ever been in history, or at least since we've been recording this data. This is the lowest level of volatility or implied volatility in the option space that we have seen. Now, much the same as traders can come in and take yield from the futures space, people can come in and sell those options like an insurance company and obtain similar yield. And again, if we're seeing that overall implied volatility is at essentially all-time lows, that's showing that we're actually having overall, there's less yield, there's less options premium that can be taken out of the market, which yet again creates this kind of lackluster or there's a low incentive for these traders to come in and actually use these tools. So what we're seeing is that the opportunity is actually likely elsewhere, and we're seeing that money rotate out of the Bitcoin space and moving elsewhere. So it's appearing in both the option space and in the futures. Now, the last thing I want to highlight here before we move on to the on-chain is this thing called a put to call ratio. So again, we spoke about this. If you're buying downside protection, you're buying puts. If you're buying upside, you're buying calls. So a higher value of this metric is showing that more people are buying put options. There's more risk hedging. There's more people who are buying that downside insurance. And you can see through much of 2021, we had this dominance of calls. This was a downtrend. There's more people buying call options than puts. As we had our August rally and we started to see the bull market start to cool off, this metric generally traded sideways. So this is bull market speculation. This sideways action is the cooling off of the bull. And again, that's kind of a signal that maybe this rally didn't have the legs to keep going, which we've then seen. And following that, we've started to move into an uptrend in terms of overall put options that are being purchased. And it makes sense. We've seen this 50% correction from the all-time high and then 3 months of sideways price action. It does make sense for traders to essentially be buying more downside insurance. There's a lot of geopolitical and macro forces going on. So at the end of the day, it does make sense that there's going to be more people buying those puts, trying to protect their positions, and essentially sitting tight, waiting for the market to find some kind of momentum. So now let's move on and close out with the on-chain activity space. Now, this is just kind of a bit of interest in understanding what's going on in the transaction volume. Now, what I want to first highlight, we have here our total transfer volume entity adjusted. So this is the clean data. It removes all of the exchange internals and entities internal wallet shuffling. So it's quite a clean data set. Now, the first thing I want to highlight is 2017 saw this massive spike in volume as we got to the bull market peak, and note how it completely wiped out. So we saw this kind of influx of demand and none of it stuck around. In our current market, we've seen that influx of demand, But note how we haven't seen the complete demand destruction. We continue to consolidate. So we've seen that there is a growth in the amount of utility, the amount of settlement volume. We are seeing stronger underlying fundamentals relative to the previous cycle, which is a good sign, and it shows that we do have more capital moving around in the system. Now that we then have our relative transfer volume breakdown by size. So what we're looking at here in the dark green, $10 million plus transactions. These are institutional grade, high net worth individual, trading firms, large amounts of capital in terms of transaction dominance. And what you can see is that particularly since October, note how this has expanded quite dramatically. We have a very, very large amount of big capital moving through the system. And you can see that over time, these green values, which is about 100,000 plus, has continued to kind of consume the overall dominance, particularly through 2020 and 2021. We've seen our very small transactions, the reds and the oranges and the yellows, get compressed into smaller and smaller regimes. So it's quite interesting that we're actually seeing larger capital in the Bitcoin market at the moment. The amount of transaction volume that is large is over 40%, over $10 million transactions represent some 40%. Whereas back in 2019 and 2020, it was less than 10% on a good day. So we have seen this kind of structural shift. We've got more transaction volume just overall, and a greater proportion of it is institutionally sized. Now, what we also have is a great deal of Bitcoin transaction volume is coins going in and out of exchanges. Now, on this particular chart, the in is shown here by the green values and the out is shown by the red values, and you can see that they actually more or less overlay each other. And this is just visual. Obviously, there's a difference between the two because we see exchange balances going up or down. But generally speaking, in our current environment, there's about $6 billion moving around the Bitcoin network on a daily basis, and about 2.1 billion of those are exchange in and outflows. And it's about a 50-50 split. Outflows at the moment are about 2.1, inflows about, 1.1 billion, and inflows about 1 billion. So there's a slight bias towards outflows at the moment, but you can see that the traces are very, very similar. But within that context, we look at that exchange transaction volume, and if we think about this, what happens if we take a ratio of inflows and outflows, so exchange related in and out, and divide it by the total? So essentially, what is the dominance of flows of coins going in and out of exchanges? And that's what this orange curve is showing. It's kind of this dominance of transaction in and out divided by the total. Now, particularly from 2016, let's just zoom in here because this is, you may have heard me talk about this before. 2016 is when the market started to reach a bit of maturity. Note that during the 2016 and 17 bull run, we saw an increase in transactions going in and out. Most of the volume was being driven by exchange in and out. This is that speculative mania. We saw it in 2016, 17, and we saw it again really from the mid of 2019 all the way into our bull market peak. So generally, we see an uptrend in transaction in and out as a result of speculation and bull market fever. Now, conversely, we see this downtrend that starts to kick in during the bear market. And we see it again here from around May onwards, a fairly strong downtrend. We're down to about 30% of overall transaction volume is related to exchanges, which means 70% is not related to that speculative trading. So what we're kind of seeing is this kind of a cooling off period. It's moving back into a more fundamental structure. We have a lot more transaction that's of a larger size. We're seeing less of it associated with speculative trading and in and out kind of transactions, which means we're seeing more of these kind of OTC deals and hodlers moving coins around and more fundamental flows, custodians essentially putting coins into multi-signatures, things that are essentially outside that very simple exchange inflow, exchange outflow. So there's a lot less of that going on. It's showing that we're kind of moving into that much more cooled off bear market period. It aligns with what we've said in past videos where we are in this hodler dominated market. And really it's kind of showing that we have reached somewhat of a cool down in terms of all the speculation, which you can also see in the derivatives above. So we do have a cohesive story the whole way through. Now, the last thing I want to close on is bringing transaction volume into a pricing model. Now, this is a methodology that Willy Woo presented a couple of years back. What it essentially looks at is the NVT ratio of the last 2 years. What are the typical values? And it assigns that typical value of overall NVT ratio, and it compares it to our current transaction volume. So it's essentially looking at what over the last 2 years, what did this transaction volume imply was a valuation for Bitcoin? Now, we have two different signals here. One is in the green, which is our 28-day. That's a fast signal. And in the purple, we have a slow signal, the 90-day. Now, what you can see is that during bull markets, note that the green typically trades above the pink. Well, that's showing that on the 28-day basis, on a much faster basis, a lot more transaction activity, a lot more utility, more people are using the network, and generally that's a constructive sign. So here we are at the top of our bull market, and note that the 28-day crossed over and started to fall down below the 90-day. We're seeing a drop-off of fundamentals, less transaction activity, there's less people using the network, and that preceded a large decline. Now, as we can see here, in early August, we had another break above and the green started trading above the pink, and we had that bullish impulse higher. There was more transaction activity, more people were using the network, and as before, we've then broken down back below. Now, what we can see at the moment is we are in the process of the 90-day starting to curl around, it may be bottoming out, and we've had our 28-day break up and above. Now, what I want to highlight, so this is a constructive sign. It's a good thing to see. But there's also been, let's look at 2018, we had a number of these break above and then collapse below, break above and collapse below. Same in 2019, some of these false signals. So it's a good thing to see. It shows we have transaction volume creeping back in. But at the same time, we just need to wait for that time confirmation. We need to actually see this confirm and really get that momentum back to the upside. Otherwise, at the moment, it's a good observation. It's something to keep an eye on. It would be nice to see if we start getting this bottom formation and this starts to actually show that there's fundamental utility flowing back into Bitcoin. But until then, let's just keep a bit of a calm eye on it and just pay attention to see whether our transaction volume really starts to support that kind of push higher, and whether this is a real signal or if it's actually just a false signal that's going to break down back below. So thanks everyone for tuning in. Hopefully you learned a little bit more about the derivative space, particularly around those perpetual versus the calendar futures. It is an interesting market. We've seen that yield is really compressed in terms of options, implied volatility, in terms of yield available in futures. We're seeing that on-chain transaction volumes are low, but they do have a more constructive baseline. This is a medium to long-term observation, so it's not something that's really going to show up in the next couple of weeks, but it's something that we can pay attention to over the next couple of weeks to see if we continue to get this strength, or does it start to deteriorate, giving us a more bearish signal. So thanks as always for tuning in. Hopefully you found this useful, and I will see you next time. Cheers.